Currency debasement is the next topic we'll be discussing on the course Why Do Prices Go Up? And all that currency debasement means is that the pound sterling devalues because the central banks issue more year on year into circulation, and it means that all of the pounds that are already out there become worth less, so they are debased. Currency debasement is not necessarily a bad thing, especially if you have a large mortgage, because as prices go up in the economy, the inflation level might be 2-3%. If you are employed under an employment contract, a lot of these will have an annual pay review, which keeps pace with inflation. But the amount that you owe on your mortgage is nothing to do with the rate of inflation. It stays constant. So what you will find over time is that the proportion of your income that is spent on mortgage payments will go down. The reason why central banks have inflation targets of 2% is that it gives them a margin of error. So if there's a year where demand is quite weak in the economy and the central bank has got a target of constant prices, which is 0% inflation rate, any slump in demand could mean that prices start to fall, and that can be quite dangerous, or at least this is what the policymakers believe, because if people notice that prices are falling, they will defer their purchases. And it makes sense, because if you wanted to buy a car and you noticed every month that car become cheaper and cheaper, you might be quite tempted to say, I'm not going to buy it today, I'm going to wait 2 months to see how low the price goes. And if this happens across the broad economy, then demand will just collapse, and then firms won't be making sales, so they'll need to lay off staff, unemployment will rise, and then you get a self-perpetuation and end up in a recession. So the last thing that central banks want is deflation. And this is a central point to this whole course. Central banks are mandated to protect the economy and employment levels. They are not mandated to defend the currency's purchasing power. So every time there's a recession or a crisis, what the central bank will do is, if they have to, they will print currency, debase it, to protect the economy and employment levels. And currency debasement distorts markets. If sterling devalues, it takes more devalued pounds to buy the same item. And this gives the illusion that prices have gone up, when really what's happened is that the currency is becoming worth less, so it takes more of those currency units to buy the same good. And currency debasement is basically a transfer of purchasing power from the population to the government, because the government get more money to spend and everyone else pays in higher prices, because the money that the government spent increases the money supply. So it means that more money is chasing the same amount of goods and services, which causes prices to go up. Now this is really interesting, because in the UK, Nationwide are a building society and they are a leading mortgage provider. They issue each month the average price of a typical property in the UK. And since the 90s, this data shows that prices have gone up in nominal terms. So against pound sterling, which is how transactions are made in the UK, you can see that house prices have gone up over time. But is this a function of the currency going down? In Q1 1990, the average UK property could be purchased for just over £61,000, but in Q1 2022, it's over £250,000 for that same property. But if you would have bought that property back in 1990 in gold, you would have spent 246 ounces of gold. And if you held onto that property and sold it in 2022, you would have only got 187 ounces of gold. So you would have made a loss of 59 ounces over that time period. So yes, house prices have gone up, but it depends on what you're valuing them against. Now this is caveated because in the 90s, gold was very depressed. Gold had quite an extensive bear market. No one was really interested in gold, and gold was very cheap. So gold sort of mean reverted, and that has distorted results a little bit. But the point is that a lot of the house price increases have been because sterling has debased over that time period. And cash deposits are not risk-free investments. You'll probably recall quite a few people saying to you, oh, I don't take chances with my money, I won't buy shares, I won't buy gold, I keep it in the bank because it's safe. But it's not safe. Cash on deposit is exposed to inflation risk. And the only thing that you can really do is swap that risk. So if you buy gold, it swaps inflation risk for gold price risk, because any money that you buy gold coins or gold bars with is no longer exposed to inflation, but the value of that asset is determined by the live spot price for gold. So you cannot remove risk, you can just change the risk that you're exposed to. And when it comes to gold and risk management, as I've already stated, that you can transfer risk. If you think inflation is going to be high, or you notice inflation is high, consumer prices are going up, and the cash that you have on deposit is just not earning any interest, you can buy some gold, because if prices go up in the wider economy, you would expect gold prices to go up. So you would accept that gold price risk. It also allows you to diversify your risk, because you might want to hold some money in your bank account in case you need it for a rainy day, but you also might want to have some exposure to the gold price and also the stock market as well. So it allows you to sort of spread your bets. So how do currencies debase? How does this whole thing happen? Well, it's all through central banks, and it's a process called quantitative easing, which is referred to as QE. And the process, you don't really need to understand the intricacies of this, but basically what happens is that the central bank will issue new currency into the system. It will buy government bonds with them, and when the government sells the bonds to the central bank, they get money in return, and they use this money to spend into the economy. And what this basically does is that it means that after quantitative easing has happened, hundreds of millions of pounds that never existed before suddenly do exist. So you see an increase in the supply of money in the money stock. And those that are interested, the transmission mechanism is here. So basically what happens is that the Bank of England will issue new currency. It will buy government bonds. The more demand for government bonds pushes the price up. So the more people that buy bonds, the price goes up. As the price goes up, the interest rate yield goes down. So it means that the higher the gilt, which is a UK government bond, the higher that goes up, the lower the interest payments the government make. But why reduce interest rates? Well, there's two main reasons for this. The first one is that lower interest rates doesn't incentivize saving. If you have a certain amount in your bank account and it's not earning any interest, then you might be like, well, I might as well just spend this money because it's not doing me any favors, especially with inflation, and I'm not earning any interest. Whereas the converse to that, if say you had 10% interest on your bank account, you might decide, actually, I don't want to spend any money. I want to try and save some money because I can earn 10% on it. So by artificially reducing interest rates, it makes people want to spend money rather than save. And this is important because your spending is my income and my spending might be your income. So it boosts employment, it boosts economic activity. So they want people to get money out of savings and spend it into the wider economy. But also, as I've already intimated, that it increases government spending, because if interest rates are low, then when the government borrows, they're paying a very low servicing charge on that debt. So it means that they can continue to borrow more and spend more. And finally, a lot of people believe that when quantitative easing happens, it is inevitable that you get hyperinflation, but that is not the case, because there's been quite a few, at least recent examples, where quantitative easing has happened and there has not been any hyperinflation. And Japan was a prime example, because in 2001, for 5 years, the Bank of Japan was engaged in quantitative easing, but there wasn't any hyperinflation in Japan.